The Forex market does not move randomly. Every major price shift has a trigger, an interest rate decision, an employment report, an inflation figure. If you are trading without knowing when those events are scheduled, you are flying blind into some of the most volatile moments the market produces. That is what the economic calendar is for. The economic calendar is a schedule of planned financial and political events that are likely to move currency prices. Each entry tells you what data is being released, which country it relates to, when it happens, and how significant the expected impact is. For Forex traders, this is not a nice-to-have. It is a core part of daily preparation. Most calendars show you 3 numbers alongside each event. The previous figure, what the data showed last time. The forecast, what analysts are expecting this time. And the actual figure, published the moment the data drops. The relationship between the forecast and the actual result is what moves markets. When data significantly beats or misses expectations, currencies can shift sharply within seconds. Not every release carries the same weight. Some are routine and cause barely a ripple. Others can shake the entire market. The ones to watch most carefully include central bank interest rate decisions from bodies like the US Federal Reserve, the European Central Bank, and the Bank of England. Also high on the list, the US Non-Farm Payrolls Report, which lands on the first Friday of each month, Consumer Price Index data, which measures inflation, and GDP figures, which reflect the broader health of an economy. The core logic is straightforward. Strong economic data tends to support a currency. Weak data tends to weaken it. When the US reports stronger than expected job growth, traders may buy the dollar in anticipation that the Federal Reserve will hold or raise interest rates. Higher rates attract investment, which drives demand for that currency. The reverse applies just as cleanly. One thing worth understanding: markets often move before a release, not just after. Traders position themselves ahead of major announcements based on forecasts. This is why you sometimes see a currency move in a counterintuitive direction right after a data release. It is called buy the rumor, sell the news. The actual result triggers profit-taking from traders who already positioned for the expected outcome. A common mistake is treating every release as a trading opportunity. Chasing every data point leads to overtrading. Learning to be selective, focusing only on high-impact events relevant to the pairs you actually trade, is a discipline that takes time to develop. A practical starting point: spend 15 minutes each morning reviewing the day's scheduled releases. Identify the high-impact events, note the forecasts. Then decide in advance how you will manage your open positions around those times. That single habit will reduce the number of times the market catches you completely off guard.